Well, there are a few cross currents coming into play that could put that in some doubt, but the support in the markets is really significant. And we've had huge fiscal stimulus, 10 to 15% of GDP, monetary stimulus, balance sheet expansion from the central banks, again about 15% of GDP. We've had 27 record daily highs in the S&P 500 this year. So the risk appetite has been remarkable considering the event that took place in terms of COVID. Again, you can see here in terms of the speed in which we've corrected from the COVID crash. It took 25 weeks for the S&P 500 to recuperate those losses. That's nearly 4 times faster than the next fastest, which was the crash in 1987. And again, then you have to go further out in terms of the length of time for the global financial crisis and the dot-com crash in 2000. The near-term current that I spoke about, those cross currents, right now today it's Brexit. It's back in focus. I think we're at the final moment. I've said that before, but I really think now we have this meeting this week between Boris Johnson and Ursula von der Leyen. They've put out a statement that there are significant differences. It's incredible to be at this point and there's still to be significant differences. The markets, though, are still hopeful. The pound has dropped, but I thought it would be down more than where we are at the moment. And I think there's an expectation that perhaps Boris Johnson will shift again at the final moment. He's done that before, so the markets are expecting that again. But if that doesn't happen, that negative cross current is going to become quite pronounced over the short term. The dollar will rebound significantly against the pound. We think back into the mid 120s. Equity markets in Europe and in the UK will correct lower. So that euphoria that we've had will certainly be tested over the coming days if we do get confirmation of a no deal. Well, that euphoria that I just spoke about, driven by the incredible scale of stimulus provided by policymakers, the vaccine announcements in November, of course, reinforced that positive mood. Rolled out probably sooner than expected, higher efficacy rates, all very good news on top of the stimulus we already have. However, we do still potentially have a difficult couple of months in terms of COVID before vaccines are widely available. Europe and the UK, the news is a little bit better, thankfully. Infection rates, death rates are coming down, suggesting the lockdowns have been successful. In the US, though, it's a little bit different. And because of the less coordinated policy response to COVID infections, we're seeing elevated infection rates. Unfortunately, the 7-day average of total deaths hit a new record high yesterday. And that's prompting policy changes. We now have 9 states that have businesses widely closed. Another 10 states where it's mixed between business closures and not. So that could start to spread further. We've had an announcement from California, for example, stay-at-home order announced. And I think the risks over the short term is that we're going to see a greater and greater economic impact. And I'm not sure that's fully priced in the markets. We're seeing a slowdown in the US economy. If it continues, we could be in a situation of contracting GDP in Q1 of next year. Assets are pretty highly valued in the US. The S&P 500 price earnings on a forward basis about 26 times, well above the long-term average. So it does suggest a lot of good news is priced. And if the COVID short-term risks continue to grow and the economic impact is more significant, it could result in a correction in risk that could disrupt that euphoria mood that's in the markets. Well, to answer that question, we've got to go back to what I was speaking about at the beginning, policymakers, on what lies ahead. We've already had the RBA, the RBNZ, the Bank of England announce additional stimulus in November. The ECB this week will announce an extension to its PEP programme, 500 billion of extra quantitative easing, extending QE until the end of 2021. Perhaps the biggest, most important event is next week, and that's the Federal Reserve. The reason why I say it's the most important is the markets are less sure about what's coming. There's been some mixed communications in terms of whether or not more policy stimulus is needed. After what I've just said about COVID, I think the grounds for more stimulus is increasing by the day. And certainly, if we get an additional add to quantitative easing, that will be a significant boost to risk sentiment over the short term. This chart here is the weekly change in assets purchased by the Federal Reserve. Of course, we had the surge in purchases when we had the worst moments of COVID, and now we've gone into this steady pace of purchases. An increase in that pace would certainly be a very powerful additional supportive measure for risk sentiment. If they don't do that, at the very least, they should announce a change in their composition of purchases to allow for greater purchases further out the curve in order to cap the 10-year yield, which again will be a very important measure if it's taken. So at the very least, I would expect a change in composition, but given the COVID, we could get a surprise in terms of the Fed being more aggressive in its announcement of stimulus. And if that was to happen, that for sure will reinforce that positive risk sentiment as we move into 2021 and the rollout, hopefully, of these COVID vaccines.